Good afternoon. It is Friday, January 12th, 2:54 p.m. So much going on, people. The stack of news that I want to get to just gets higher and higher and higher. I'm just going to try to cut through this and get it done as much as I can. So I think I'd like to start with, first, let's start with a picture. Okay, which I caught at 9:40 New York time, right? They whacked gold down again, right? It had been moving up, right? 1332, they tried to whack it down, right? And then it started to make a little recovery. It's still up $5.10 at this point, right? Now, last week I said that the gold cartel was 0 for 2, right? They tried to whack down gold with the release of the FOMC minutes. Didn't work. They tried to knock down gold with the non-farm payroll report last Friday. Didn't work. 0 for 2. Now they're 0 for 3, okay? Now they're using the CPI data, which came out today, which was hotter than expected, to knock down gold. Didn't work. Didn't even come close. All right. So have a little article here, one of many. When you read something, you kind of get an idea of the author, right? Because people have a thought, right? And then they express it in a word, right? So when an author puts his words down on paper, you kind of get an idea about his thoughts. And you start to notice the same authors writing the same hit pieces, okay, which I said, right? I warned you about it, right? And you see the same name come up with the same hit pieces and the same dribble, okay? So this came out today, right? Gold prices have fallen from their 4-month highs following stronger than expected U.S. inflation data. And that's the big thing today, I believe, people. Stronger than expected U.S. inflation data. This mystery that the Fed can't find, right? I don't know where they're looking. Friday, the U.S. Consumer Price Index rose 0.1% in December after increasing 0.4% in November, the U.S. Labor Department said. According to consensus forecasts, economists were expecting to see an increase of 0.1%. However, monthly core inflation, which strips out volatile food and energy costs, rose 0.3%, following a 0.1% advance in November. Economists were expecting to see a 0.2% rise in price pressures. Okay? They finally might be getting the inflation that they so desperately want and they've been searching high and low for. Now, this author says, as of 8:32 a.m., he's got the precise minute. As of 8:32 a.m. Eastern Standard Time, COMEX February gold was up $5.40 at $1327.90 an ounce, right? 2 minutes prior to the report, the metal was up $9.60 to $13.32 an ounce, right? So they use this report as just another failed attempt to knock down gold, all right? And that's not even what I really want to get in. That's not the heart of today's video, okay? It's just one of many things, okay? So it goes on, looking at some of the components, the report said that food index increased 1.6% in 2017, while energy increased 6.9%, okay? So, this is by Niels Christensen, okay? All right? Remember, right? You kind of get a sense of the author, all right? By his words, by what he says, all right? So, this inflation, right? Now, this is the chart. I've been taking snapshots of the yield curve. I've been capturing the yield every day. I put it in a spreadsheet, right? Now, 2-year Treasury yields top 2%, for the first time since 2008 as inflation rises, right? I've said this before. I'm going to say it again. Inflation is never a bad thing for gold. Inflation is never a bad thing for gold. No matter how they want to spin it, like this guy and everybody else, okay? Because the superficial thinking, okay, is, well, if inflation is heating up, the Fed will just fight inflation and raise rates, and that will be bad for gold. No, it's the real rate of inflation that matters, number one. And two, the Fed will be way behind the curve, all right? Inflation is never a bad thing for gold, okay? 2-year Treasury yield tops 2% for the first time since 2008 as inflation heats up. So the 2-year, okay, has crossed the 2% threshold the first time in 9 years. A lot going on with this bond market, all right? Yields rose Friday after consumer price data posted its strongest gain in 11 months. The yield on the benchmark 2-year Treasury note topped 2% for the first time since September 2008 after the price data, all right? The Labor Department said core consumer price index, that's what I just read, which excludes volatile food and energy components, rose 0.3% last month, beating expectations. Now, this is the yield curve, which is getting flatter and flatter and flatter like a pancake, okay? Now, there's some people that are already calling the end of the bond bull market. Bill Gross. There are other people that say we're close. Jeff Gundlach, right? But yet the 10-year really isn't rising. But the short end of the curve is flattening out this yield curve more and more. Okay? So there's the yield curve, right? Let me see if you could see that. And this, look at the spread. The spread between 2s and 30s, 0.857. So you can tie up your money for 28 more years and not even get 1% for it, right? The spread on the 1 year and the 30, 1.07, right? Tie up your money for 29 years for an extra percent? You got to be crazy, excuse me, right? So these spreads are getting tighter and tighter and tighter. Let me zoom in so you can see that. That's the duration, 3 month, 1 year, 2 year, 5 year, 10 year, 30 year, right? That's the yield, right? Get a good look at that. That's the spread, right? The spreads, okay? Very tight, very tight. That's the graph right there. Let me pull out. You can see look how flat that is. So this yield curve is getting flatter and flatter, okay? The short end is coming up, okay? Now, I move forward. I saw this article. I actually read it about 2 days ago. I think it was 2 days ago, right? I haven't even gotten to it. There's so much more I have to get to here, right? This article is so insulting in my view, okay? So offensive, so false, right? Just a lot of circular reasoning, right? I want to read this to you. Jim Cramer, okay? The CNBC cheerleader and shill, right? Jim Cramer. The more treasuries the Chinese dump, the better. The more treasuries the Chinese dump, the better. You can't be worried about one side of an equation and then be worried about the other. It's illogical and lacking in rigor, but it happens all of the time and totally threw us off in today's session. Let me explain what I mean so you can see how a bullish situation gets turned into a bearish one by those who want it both negative ways. All right, okay, there's so much to chew on here, right? All right, so we're going to get a lecture about how we're spinning a bullish situation into a bearish situation, okay? But every day on CNBC, right? The spinmeisters, right? That's all they do. Everything is always bullish, right? Interest rates are going down. That's good for stocks, right? Interest rates are going up. That shows the economy is improving. That's good for stocks. Oil is down. That's good for the consumer. That's good for stocks. Oil is up, right? That's good for the oil companies and jobs. That's good for stocks, right? Stocks are up. You're in a bull market. Buy stock. Stocks are down. Well, it's a good time to get in. Buy stocks, right? It's always a good time to buy stocks, right? No matter what, buy stocks, right? Whatever the news is, it's bullish, right? But we're not allowed to, say anything is bearish, right? I guess we don't understand, right? Right? We really don't. We don't grasp these complex, concepts, right? You can't be worried about one side of an equation and then be worried about the other side. When I went to school, I learned that an equation meant equality, right? It's equal. What was on the left side of the equation equaled the right side of the equation, no? Right? 5 equals 5. 3 plus 2 equals 5, right? I remember I went to college, right? I had these math courses. On the left side of the equation, you can have this complicated statement, right, with derivatives and probability, right, and factorial, and all that, hey, equals 4, right? So you look at the left side, it's so complicated, right, and you try to reduce it and everything, and you forget that big complicated thing equals 4. And my professor used to say equals really does mean equals, okay? So let's keep that in mind, because if you're going to worry about the left side of an equality, well, that only stands to reason you're going to worry about the right side of the equality, because they're equal, okay? Now, all right. This morning, we awoke to a story about how the Chinese, huge buyers of our treasuries, are cooling to them. That freaked out people badly, and millions of shares came in for sale at the opening because of the terrible implications of the Chinese perhaps dumping their 1.2 trillion treasury hoard. One of the principal worries of seasoned portfolio managers is that there is no inflection in the yield curve. No inflection, and we're just looking at this flattening yield curve, right? And it's a worry, he's saying, one of the principal worries, that you are almost getting the same return for short-term treasuries as you are for longer-term, and we just showed that. That means we have what's known as a flat yield curve, something that is often a precursor to a recession. Okay? No, not often. Since 1970, I've shown, a flat yield curve is always a precursor to a recession. Okay? Makes some sense, he says. The Fed raises rates too quickly, loan demand falls off, the economy worsens, and we get thrown into a recession. But if a huge seller comes into the market and starts dumping longer-term treasuries, there will be that inflection and the flat curve will go away. All right, so if the Chinese dump treasuries, right, the long end of the curve, the interest rates spike, right? Okay, well, we don't got the flat yield curve anymore, but now we got runaway hyperinflation. So what is he talking about? This is not a spin. But if a huge seller comes into the market and starts dumping longer-term treasuries, there will be that inflection and the flat curve will go away. That's positive because it removes the case that a recession is right around the corner. More circular logic, okay? It's like if it rains out, the ground is wet. It doesn't mean that if the ground is wet, it rained, right? If the yield curve is flat, we're going to get a recession. It doesn't mean if we have a recession, the yield curve is flat, okay? He says, I am so adamant about this that I wish the Fed would sell off its gigantic treasury position, which would accomplish the shooting up, spiking of the long end of the curve. Okay, he wants the Fed to dump this huge, gigantic treasury. Who's going to buy them, people? Who's buying them? Okay? Oh, yeah, let's all dump it. Well, who's going to buy it? At what price? Okay? He's adamant about this. So am I. Okay? Plus, ever since President Trump was elected, I have been calling for a 50-year $500 billion bond offering for Make America's Infrastructure Great Again. It would kill two birds with one stone. I think it'll kill a lot more than that. Building new bridges and tunnels and allowing interest rates to rise. These guys love debt. They love debt, right? Just more debt, more debt, more debt. Build the tunnels, build the bridges, fix the roads, fix the airports. More debt, more debt, more debt. Utopia, cider, it's cider. So tell me, how can we be worried that if longer rates don't go up, we might go into a recession? But if they do go up, there might be a slowdown because banks won't be making enough money lending money off your deposits. You mean to tell me both sides are bearish? Yeah, both sides, things can be bearish, right? If you increase the speed, there'll be a higher incident of traffic accidents, right? Higher speed equals higher accidents, right? I mean, what's the problem here? If your temperature goes up and it's rising, well, your fever goes up. Let's worry about both sides, right? It's an equality. So I'm a little confused here, okay? That's just insane. Not only that, but if you really believe that this is the case, I have bad news for you. The so-called sell-off in bonds and therefore concomitant rise in rates is so small that you need a microscope to see them. I got in this business when interest rates were 14%. When they went down to 11%, we were celebrating. Keep any rate scares in perspective. Yeah, but what was the debt when you got into the business? Okay? What was the debt to GDP when you got into the business? Okay? You can only simulate something once. Okay? It's a real inconvenient truth, I suppose. Now we have $20 trillion in debt. Okay? 11% interest, 14% interest. And let's make it clear, this isn't a be careful at what you wish for story. We want rates higher. The loan growth in the country is slowing, something we will hear when the big banks start reporting on Friday. The more bonds the Chinese dump, the better. The more bonds the Chinese dump, the better. The more bonds the Chinese dump, okay, the dollar is going to sink like a rock, okay? And long-term rates are going to skyrocket, okay? And what's that going to do for mortgages and refinancing and the housing market, right? And what ultimately that's going to do for jobs, right? So I don't get it. I don't get it. Similarly, we are hearing that inflation is heating up, particularly in Europe, where the Germans have seen an 11% increase in yield since the year began. Put aside that German rates are so low that if you buy their bonds, you can actually lose money. The operative term is inflation and how it is suddenly the big issue. Do you know that just last month the real worry was lack of inflation? The real worry was lack of inflation. I'm not worried about inflation. Nobody's walking around worried about inflation except the bankers, right? Except the Fed. They're the only ones running around worried about inflation. Are you worried about inflation that you're not paying enough? So what's he talking about? The real worry was lack of inflation. I wasn't worried about it. The Fed seems to be the only people worried about inflation, right? Not enough of it. Yet, when we heard that there may not be enough inflation, we recognized that perhaps the workers won't get paid more. There it is again. This discredited, disproved Phillips curve, right? Wage growth, right? We got to get inflation, right? Wage growth. Discredited, disproved. Junior year textbook. That marginal companies might go out of business because of a lack of pricing power and that we can't raise rates like we thought we would. Something that's terrible for the most important leadership group, the financials. When things looked terrible at the beginning of the session because of inflation scares, we saw that the stock of JP Morgan started to rally. Other banks soon followed suit and they quickly turned around the market as they almost always do. You can't have it both ways. You can't say boo-hoo, there is no inflation, let's sell stocks, and then say boo-hoo, there is inflation, let's sell stocks. No, you can't have it both ways unless you're CNBC. Then you could always say, yay, let's buy stocks. Oil is up, yay, let's buy stocks. Oil is down, yay, let's buy stocks. That you could do. That's okay. Then there's oil, and I want to get to oil, people. I really want to get to oil. Now that oil is comfortably above 60, we are hearing about how dangerous these newfound prices could be for the consumer and for the corporations, and how inflationary it might be. Every time oil is mentioned these days, it is in the context of the breeding ground for inflation that it had become. It's a regular cliche that gets added now every time anyone mentions oil. Oil is inflationary, right? But a couple of years ago, when oil was on its butt in the 30s and 20s dollars per barrel, all we heard was that if it kept going down, it could take employment and bank balance sheets with it. So lower oil prices is a bad thing. Okay, according to this article, right, and people, right, certain people, right, lower oil prices is a bad thing, right? We had endless fretting about how oil and gas declines were the next big negative. The economics of the once red-hot states of Texas and Oklahoma were in the balance. The big banks could have humongous losses. There were even some conference calls devoted totally to the issue of the danger of falling energy prices that also lamented how our independent oil companies would run out of cash and create huge hole in the junk bond market. What was needed? Higher oil prices, much higher, high enough to get drilling to accelerate, to put people back to work, to take the pressure off the banks, and to eliminate the threat of looming bankruptcies. Bring on higher oil, it's good. What was the sweet spot price where we would have a pickup in construction, a resumption of drilling budgets that would go higher, and an elimination of any of the biggest potential bankruptcies? What's that sweet spot? There's always a sweet spot. With the Fed, it's 2%, right? 2%. They supply the supply of money, right? They decide. So there's a sweet spot with oil, right? How about a price north of 60? That level would be where employment picked up. The need for pipelines, huge job creators, would accelerate. The banks would be able to eliminate criticized loans and not have to put a lot of capital behind them instead of lending it to the businesses. And oil companies would be able to do more than just break even if they drilled in more places than just the Permian in Texas. Plus, that mid-60s price wouldn't raise the price of gasoline at the pump. No. Won't raise the price at the pump, no. So much it would crimp the consumer, especially because the new cars use much less gasoline. So here we are with prices at last where we want them. And what happens? The prices, according to this article, are exactly where we want them, right? We hear that we are dead men walking now that they have gone higher. You can't make this stuff up. Okay, you can't make this stuff up. This is oil. Right? This is going back to 1983, the chart of oil, right? 1983, right? We had that huge spike, right, in 08, came back down, right? Started to go up. That spike, by the way, was north of $125 a barrel, right? Came back up between 2011 and 2014, north of 100. Came all the way back down, right? He talked about it being in the mid-20s and 30s, oil, right, on its butt. And now we're looking at oil today. It's actually over 64. When I printed this, it was 63.86. Now it's $64 a barrel. It's broken out of some key resistance lines. And you see that zone of resistance right there? 68 to 74, I'm calling it. If we take out this 68 to 74 zone of resistance, you're looking at $100 oil again. You're looking at oil north of $100, okay? So, are higher oil prices good for the economy? Are lower oil prices, bad for the economy? The recession, 1973 to 1975, stagflation. Some of you might remember those days, right? The misery index, stagflation, the mid-70s, right? That was the recession of 1973 to 1975. What brought it about? The 1973 oil crisis. Oil went from $3 a barrel to $12 a barrel. It quadrupled. Higher oil prices was a bad thing, okay? The recession of 1981 to 1982. What brought it about? The 1979 energy crisis. Oil went from basically $16 a barrel to almost $40. It basically almost doubled. Higher oil prices was a bad thing, okay? The recession of the early 1990s. What brought it about? The 1990 oil price shock and increasing debt, okay? Oil was $17 a barrel. It went up to $36 a barrel. Again, more than doubling with the Kuwait, right? Oil prices were rising oil prices were a bad thing, all right? So I'm not buying this, okay? Oh, it's good. It's the sweet spot, okay? I'm not buying this, okay? Sadly, I am used to these scare tactics. Okay, so this is all scare tactics. Other than the amazing Warren Buffett, who counsels a long-term approach where things even out and equities do well versus the bond market competition, most money managers want to talk about what can go wrong, even if it directly contradicts what they were hoping for. Blah, 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 blah. The bottom line, don't be careful for what you wish for. Embrace it when it happens and stop contradicting yourselves. It's embarrassing, and you ought to take another job as an actor in a scary film, or at least one of those people who jump out at you in theme parks, haunted houses when you most expect it. Okay? So you're an actor if you're not a cheerleader, if you're not, yay, buy stocks on CNBC, everything is always wonderful. No, if you're not part of them, you're an actor and you belong in like some sort of amusement park, okay? Jumping out at people and yelling boo, okay? I find this so insulting, this nonsense. I really do. This video is very long and I haven't even gotten to a lot of my stuff, to be honest. I'm going to say one thing. Gold hit my 1340 target, all right? Now I say this is not an investment. This is a war. Gold's up $15 today, $1336.90, all right? It hit my 1340 target, all right? And if you think they're not going to throw everything in the kitchen sink at gold, you're out of your mind, because that's what they're going to do here, all right? This is like the Battle of Shiloh. This is like the hornet's nest at this level, okay? So we got to keep this in mind, all right? So we got to watch this. The dollar's getting absolutely crushed today, okay? Maybe it has something to do with China dumping those treasuries, right? Bring it on, all right? So much more to talk about, people, but that's it. We're going to have to wrap this up. I mean, this is turning into, I don't know what. Anyway, a little rainy out there today, but if you can get out, take a good walk this whole weekend. Really, just try to take a step back. Keep things in perspective. I think it's important. Renew your mind, renew your spirit, right, and your physical. You got to be strong, right. This is very could be stressful. Okay, I was playing a game of chess last night. 2 games actually, 6 hours I was playing, and mental fatigue sets in, believe me. I won both games, but my opponent, he just cracked. So it's important. Anyway, have a good weekend. Thanks for your viewership, your comments, your likes, and Lord willing, we pick it up on Monday. Ciao.